Let's understand more about the outlook going ahead. For that, we are being joined by Dinanath Dubhashi, who is the Managing Director and CEO of L&T Finance Holdings. Hi, very good afternoon, Mr. Dubhashi. The retail book growth is healthy, but do you see this momentum sustaining through the rest of the year? Because on one hand, you have bottom of the pyramid borrowers benefiting on account of the inflation, while on the other hand, the urban consumer discretionary categories are seeing some bit of a sluggishness. So what's the outlook on this one?
Way to sustain growth is to farm your existing customers. That is something we were not doing well at all till about 18 months back. As of now, we have 2.1 crore database of existing customers. And over the last about 18 months, we have invested a lot in data analytics to see how we can cross-sell and upsell to these customers. To such extent that we even changed the organization. If you would remember, about 18 months back, our organization was product line based. From that, we shifted it to customer line based. So we have one line now for rural businesses, we have another line for rural individuals, then urban businesses and urban individuals. So now there will be hook products for each one of them and then cross-sell products for each one of them. I will just give you some headline numbers. Today, 34% of all disbursements happen to existing customers. 34%. So now you see, now this 34% suddenly becomes our right, our business. Hamara hak hai. It's like our business to do. That is not as seasonal as new business. And as this percentage increases, the company will be more and more sort of insulated, if not completely protected from seasonality. That is why, okay, will we grow 34%, 35% every year? I don't know. Maybe there will be years that we will grow at 28, 29%. Maybe there will be years where we will grow at 40%. I don't know. But that kind of growth rate of 25% plus, we are quite confident of maintaining because of this deep-rooted and long-term strategy that we have adopted of farming our existing customers. And that is going very well. I hope that answers your question.
I'm confident on the growth ahead. But Mr. Dubhashi, like you mentioned that most of the Lakshya 2026 targets have already been achieved. But now, would you be looking at revisiting this guidance and maybe upping the ante?
Good question. So you see what has been achieved, right? It has been achieved. All the targets are in terms of ratios. So whether it is a retail percentage. So we have achieved 82%. We have already set a target of 90. That there is no surprise in that. That I had told last quarter itself. That we will achieve 90% in 2024 itself. Now all others are ratios. Whether it's asset quality, whether it is profits. Now having achieved these ratios, the target is going to be very simple. To achieve this growth of a minimum of 25% year upon year till 26, till the year 26, while keeping this profitability and asset quality intact. Ideally, we should be able to deliver that quarter upon quarter steadily till everybody comes to know L&T Finance as a company which delivers steady growth at steady asset quality and steady profitability quarter upon quarter upon quarter. That was the purpose of Lakshya 26 and that remains the same. So, when I say we have achieved the target, it is not the target in terms of retail balance sheet size that we want. That needs to be achieved. But what I meant was the quality of Lakshya, the ratios of Lakshya have been achieved. And now having achieved this, we have to maintain these ratios and achieve this growth year upon year.
Okay, your NII is up 14%, your PPOP is up 8%, but PAT has more than doubled. For the interest of our viewers, could you highlight some of the factors leading to this?
Oh, very clearly, it's a big reduction in credit cost. If you take the consolidated number, credit cost has come down by almost 40% from close to 800 crores last year to 475 crores this year. As asset quality is stabilizing and improving continuously. We are seeing zero DPD improving. We are seeing current bucket collection efficiency improving. We are seeing NPA ratios improving. As these improve, very clearly, credit cost is going to be low, like it is in Q1. Also, I would like to point out that Q1 last year, there was also an impact of the one-time restructuring of some of our products that we had done during COVID, becoming NPA, and that impact was there in last year Q1. But this big improvement in credit cost is what is driving the profitability very clearly, along with, of course, sustainable growth and good margins.
Okay, Mr. Dubhashi, in our last interaction, you had indicated that the cost of the funds could rise by 25 to 30 basis points over the next 2 quarters. Has this panned out as per your expectations? And how do you see the borrowing cost to pan out from here on?
I think, generally speaking, if we say, we are now in a prolonged period of stabilization. So, if you see from last quarter, our increase is only 6 basis points, which is clearly less than what even I had expected. I had expected 10 to 15 basis point increase in 1 quarter itself. As you had said, I had talked about 20 to 30 basis points over 2 quarters. But in this quarter, we have seen only a 6 basis points increase. So, we believe that cost of funds should stabilize around this level. That doesn't mean that it can't go up by 10, 15 basis points. These increases can happen. But generally speaking, you see over the next 4 to 6 quarters, we don't see any big increase, either increase or big reduction in cost of funds. We believe that we are in for a prolonged period of steady cost of funds and steady margins, which will encourage us very much, because all the as economies of scale kick in, cost of operations, cost of credit will trend downwards, and at steady margins, it is great for the profitability.
Your asset quality has improved and is well within your targeted range. But from here on, given the kind of the disbursements you are doing, what is the NPA formation on the incremental book? And wanted to get a sense on how your asset quality is expected to move ahead.
I mean, very, very good question. See, the way to monitor this, which I always say, is monitor your zero DPD. The way to monitor 90 plus is monitor zero DPD first. Stop the flow from there, and then your 90 plus will be good anyway, right? And that is another advantage of doing that, is you can see well in the future that how your asset quality is going. And I can sound very confident here. Our asset quality has been continuously improving. The next stage 3 is in the area of 0.7, which I believe is a very healthy level. And we aim to stay at that around between 0.65 to 0.75 level throughout as we go ahead.
Okay, Mr. Dubhashi, you were instrumental in shaping up the organization that L&T Finance is today. But with your superannuation next year and Mr. Roy taking over, what are the transition plans in place, and what's next for L&T Finance, and how would your role evolve from here on?
I am MD CEO till 23rd of Jan, and after that I will remain on the board for 3.5 more months, and on April 30th I will retire. So that's as simple as that. After that, there will be no role in the company. I plan to follow my own interests as we go ahead. Now, talking about the transition, this is a company, like most companies in L&T Group, we believe in very, very strong management bandwidth, and one person should not make a difference. That's the philosophy that we follow. We have a very set business plan, a very set strategy, a strong GC, as we call it, which is the second layer. Sudipta has already joined us. He will be within the company for close to July, 8 months. before he takes over as MD CEO. He is currently COO, will be looking after all the businesses. So this entire transition plan has our own L&T mark of planned and very planned in detail and gradual transition as we go ahead.
Okay, with this, we'll let you go on that, Mr. Dubhashi. It was great having you on the channel, and thank you so much for joining us today. So that was the management of L&T Finance, sounding very confident on the growth outlook going ahead, and also highlighting that the asset quality has been improving quarter after quarter for this particular company.